I'm Al Brooks. Thank you all for being here. And this is the Money Show, Orlando, Florida, February 8th. Today I want to talk about end of the day traps. I'll begin by talking about what I mean by a trap. A trap is simply a breakout that fails. I'm going to be focusing on traps that occur late in the day. I'll begin by talking about end of the day bull traps. A bull trap is a rally late in the day that reverses down. Sometimes you get a rally late in the day that it looks like it's going to reverse down, but instead it continues up, and that's a failed end of the day bull trap. Next, I'll talk about bear traps. So a late sell-off that reverses up. Sometimes you get a late sell-off at the end of the day that actually leads to a bear trend, so it's a failed end of the day bear trap. Now, what is a trap? Anytime you see a trend bar, in this case bull trend bars, one bar, several bars, it's a breakout. And here are examples of two breakouts. And just looking at the chart and you're seeing the breakouts is not enough. You need to know what took place leading up to the breakout. No? And I have a rule: if the market's in a trading range, it resists breaking out. 80% of the time, breakout attempts will fail. And if it's in a trend and it's trying to reverse, 80% of trend reversal attempts will fail, even if the reversal attempt looks very strong. Now look at the two charts. On the left, leading up to the breakout, the market's in a trading range. And my 80% rule says that 80% of the time, that's not going to lead to a trend. What it will do is lead to a continuation of the trading range. And no one's really trapped here. So, this could, if you want, you can call it a bull trap if it reverses down. But everybody expects that this is not going to lead very far, that it's a bull leg in a trading range. And that's what we had. It was a rally. We got a little bit more up, wedge top, but then back down. On the other hand, take a look at this. Similar to this, 4 consecutive bull trend bars. However, what's different is what led up to this was a strong bear trend. And my 80% rule is that 80% of the time, if you get a reversal, no matter how strong it is, if you have a strong bull trend, the reversal is going to fail. This reversal is strong enough up so that when you look at it, you think there's going to be at least a second leg higher, right? And if you don't get that second leg higher, all the bulls who bought up here expecting a second leg are going to be trapped. This is an example of an end of the day trap. A very strong reversal, strong enough to make traders think there's going to be at least a second leg up, maybe a bull trend, and instead it immediately reverses down. And the key is right here. As soon as you see a bear bar closing near its low, especially if you get a bear bar like this closing very near its low, then this rally is probably a trap, and the bear trend is probably going to continue down. Bulls who bought got trapped, right? So the bulls who bought this big outside up bar thinking it was the start of a bull trend, thinking that at least it'll get to the top of the sell climax here, they're trapped. They're trapped into a losing long, and they get out below either of these bear bars. And the bears who took profits and get out, if they do not sell again, they were trapped out by this rally. They were looking for 2 legs up and then planning to sell again, and instead they got trapped out and they had to sell as it went down. So a bull trap traps bulls into a bad trade, and it traps bears out of a good trade. And this is a bear example. We have 3 bear bars, 2 of them pretty big. And here we have 4 consecutive bear bars. But again, context is important. What took place leading up to the bear breakout? In this case, it was a trading range. And therefore, 80% chance this is not going to lead to a bear trend, that it's a bear leg in a trading range, and that you'll soon get a reversal back up, which is what we did. On the other hand, what took place to the left of this reversal? Again, this is very similar to this, but the context is important. And here, you're getting a very strong sell-off in a bull trend. And it's strong enough to make traders think there's going to be a second leg down. So there are traders selling here, expecting at least a small second leg down. However, if you see a bull bar closing above its midpoint, especially a bull bar closing near its high, it's probably a bear trap. So the bear's selling here, hoping that we'll get a lower high and a second leg down, got trapped into a losing trade, and they gave up here. And there are also other bulls who, after seeing 4 bear bars, they got out. And they're trapped out of a winning trade, and they have to buy again. So a bear trap traps bears into a losing trade, and it traps bulls out of a winning trade. And the key is, if you have a big sell-off, and you're thinking it might get a second leg down, but then you start to see bull bars, especially a bull bar closing near its high, it's probably a bear trap, and the bull trend will probably resume. When you get a bull trap late in the day, I call it an end of the day bull trap. Here I got 3 examples. Here we have a bear trend and then a series of bull bars. Here we have a trading range and a series of bull bars. And here we have a bull trend and a series of bull bars, all fairly late in the day. And every one of these instances, the rally looks strong enough to have a second leg up. And therefore, it's a potential trap. And the key is, do you get bear bars closing near their lows? And if you do, the bulls will get out and the bears will sell. Here, in a bear trend day, usually in a bear trend day, you're going to get some profit taking at the end of the day. The bulls will look at this and say, yeah, my stop is way up here. I don't want to risk that much. We might go sideways, we might go up. At the end of the day, I'm going to take some profits. And they do. And typically, they like to wait about 10 bars, 2 legs, to see how strong the bulls are. And if the bulls are not all that strong, the bears will sell again. If, on the other hand, the bulls are very strong and you get a bull trend, the bears are not going to sell again. And one key is, if you start to see bear bars, especially bear bars closing near their lows, chances are it's a bull trap and the market's going to go back down. Traders will look to sell below bear bars closing near their lows. So this is a bull trap in a bear trend. And this is a similar bull trap, but in this case it's a trading range. So you can get a bull trap in a trading range, you can get a bull trap in a bear trend, and you get a very strong reversal. It looks like we're going to get a second leg up, but look to the left. If it has not gone far above a lower high, it's probably a double top, and you might break below the neckline and fall for a measured move down. Same here. Look to the left. If there's a potential double top, or even up here, it could be a trap. And finally, you can get a bull trap in a bull trend as well. A bull trend and then an acceleration upward in the bull trend, but it's an exhaustion gap, an exhaustive move. And same principle, you start to get bear bars, especially a pair of bear bars, a micro double top. Bulls will get out, bears will sell. I am not going to be talking about bull exhaustion gaps today, so I'll be talking about bull traps in bear trends and bull traps in trading ranges, not in bull trends. Bear trend, and late in the day, very tight bear channel, the bulls are going to want to start to take some profits. So you expect that there's going to be a strong rally at some point late in the day. And that's short covering. If bears are short and they're covering their shorts, it's short covering. And so you have to expect, anytime there's a bear trend, there's going to be a short covering rally. And a lot of times it's strong enough to make traders believe that there'll be at least a second leg up. And this is probably strong enough to make traders believe there'll be at least a second leg up. This was the second leg up. It was sideways. If you get a bear bar closing near its low, especially a second sell signal, this is probably going to be a trap. The bulls will get out below that bar, bears will sell below that bar, or below this bar, or below this bar, or this bar, or this bar. Any bear bar closing near its low is a reasonable short. When you get a strong rally in a bear trend, always look to the left at the most recent lower high. If this rally does not go far above that lower high, you got to be thinking it could be a trap and the market could resume down. Traps, I'm talking today about traps that are occurring late in the day, but they can come anytime during the day. Sometimes on the open, you'll see an extremely strong rally and it immediately reverses down. And it's an opening reversal down, and it's a type of bull trap. And earlier this week, I think it was Tuesday, we had a sell climax on the open, right? And it was a bear trap. It immediately reversed up. But today I'm talking about things that take place late in the day. Again, this is a short covering rally. Anytime, by the way, anytime you see a bear trend that becomes a bull trend, it always begins with short covering. So every bull trend begins with short covering. Profit taking by the bears, and if the profit taking is aggressive enough, if the bears are deciding that this is it, this is the end of the sell-off, they'll buy back their shorts aggressively. Bulls will see that and they'll buy as well, and you can get a reversal. But most of the time, a short covering rally is going to be a trap, and the trend is going to continue down. Again, if I'm a bull and I bought this, I'm expecting it to be a minor reversal, stalling around the trading around the moving average or around a prior high, and I'm going to get out around the resistance. And if not around the resistance, I'm definitely going to get out below a bear bar closing near its low. So I'll get out on this bar when it trades below that low. And some bears will sell below that bar, especially since it's a micro double top and a test of the moving average. It failed at the moving average here, 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 so it might be failing at the moving average. So bears will sell here. They'll definitely sell here, a micro double top, a low two short. And they don't take all of these shorts, but all of them are reasonable entries for bears. We've got a bear trend, and we've got 4 bull bars, and this one is even bigger, so it's starting to accelerate up. But it's also right at the moving average, and we could not get above it here, 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 here. So this could be a trap. So, I'm sorry, what? That's a 20-bar exponential moving average. Okay. I've always used that. You can use anything. I had friends who have used all kinds of nutty things like, 34-bar weighted moving averages, and it doesn't matter. You just pick one moving average, get accustomed to how the market behaves around it, and just keep using one thing. So we got some strong buying, and anytime you get buying in a bear trend, it's short covering. The bears see maybe a wedge bottom, 1 pause, 2 pause, 3 pause, 4 pause, right? And they're concerned maybe it'll be the low of the day, maybe better lighten up on some shorts, and they wait to see how strong the bulls can get. Can the bulls get strongly above that moving average? And they did not. The bulls took profits. The bull scalpers took profits. They were not willing to buy up here. They were selling out of their longs here, and the bears sensed it. So you got bulls and bears selling. You got a bear bar closing near its low. This is probably a bull trap. Traders will sell below bear bars closing near their lows. And this is what took place over the rest of the day. This is an unusual day. This is a stock market crash on the 5-minute chart. And the range here is actually huge. This rally is a 15-point rally, even though it does not look like much, but it's a huge rally. And this is an even much bigger sell-off. And then look at this, a huge bull bar closing on its high and a sell climax, and we raced up strongly to the moving average. However, we did not break above a prior lower high, and now we have a bear bar. It's closing near its midpoint, but look at this bear bar closing near its low. Bulls will get out below any bear bar, and bears will start to sell below bear bars closing near their lows. And this was just a huge bull trap. It was a 62-point rally in the E-mini, all right? All right, that's a totally huge rally. It's small compared to the size of the sell-off, but it's a huge rally. But you trade it the same. Bulls are going to buy above this huge bull reversal, and they hope it breaks strongly above the moving average, but then you get this bear bar. Bulls will get out below the bear bar, and bears will sell below this bear bar, hoping for a continuation of the bear trend, which they got. There are many bear bars closing on their lows. Any of them is a reasonable short. Now, I said these bars are huge. It's really important to realize if you have a huge bar, it's a problem for a lot of traders. For example, let's say this might be a 40-point tall bar, right? It's a great buy setup, but a 40-point tall bar. And if it's the E-mini, that's risking $2,000 a contract, right? And if you're trading, you should never be risking more than 2% of your account, 3% of your account. So if you're taking this buy, your account has to be basically a $100,000 account. And if you don't have a $100,000 account, you cannot take that buy. And what do you do instead? You watch. You just wait. If a trade requires you to risk more than 2% of your account, 3% of your account, you just wait. You just don't take the trade. Here we have a gap up, pretty good sized gap up, and a rally. And then the market went sideways. You can call it a triangle, basically horizontal trading range. And we have a breakout below the bottom of the triangle. A triangle is a trading range. And we have a reversal up and a bigger bull bar, so it's starting to accelerate up. But always look to the left, okay? Is it breaking strongly above prior lower highs? If it's not breaking strongly above prior lower highs, it might not be the start of a bull trend. It might be a bull leg in a trading range, or it could be a double top with one of these lower highs and a bear trap. So what are you looking for next? You're looking for a bear bar, okay? Is it going to be a bull leg in a trading range, or is it a bear trap, a bull trap, and could we break below and get a reversal? And if you get a bear bar closing near its low, especially a pretty good sized bar like that, and you're long, it doesn't matter if you have 5 consecutive bull bars. You got to get out, because this could be a double top with that. We could break below the neckline and fall for a measured move down. Bulls get out below a bear bar closing near its low, and bears will start to sell. Some bears will take the first sell, some will take a second or third sell. And this is what happened. We ended up reversing. So gap up, bull trend, trading range. The bulls wanted trend resumption up, so they wanted leg 1 sideways, leg 2. Instead, we got leg 1 sideways and then reversal down. And the key is bear bars closing near their lows. Bears will start to sell, bulls will give up, and you can get a swing down. Here we have a bear channel. A bear channel is a bull flag. 75% of the time, if you have a bear channel, eventually you're going to get a bull breakout. In this particular case, it's a double bottom major trend reversal, and we have a pretty good reversal up. Bulls will buy above this bar, betting that it'll be a double bottom. We'll get above the buy signal bar, we'll break above the neckline and rally for a measured move up. But always look to the left. Yes, the market went above the neckline of the double bottom, a lower high, which is good. But whenever you have a sell climax and you get a reversal, there's also resistance at the top of the sell climax. So this could be simply a test of the sell climax high. It could be vacuumed up to that resistance level. This means that there might be a lot of bears selling up here. And if the bears think it's going to go up to this price, are they going to sell here? No. If you think it might go here, you don't sell until it gets there. So there's an absence of sellers, and the market can accelerate up to the area where the bears are going to suddenly appear. As strong as this is, if you see a bear bar, you got to be thinking that it could be a buy vacuum test of resistance. It could be a bull trap. We're near that lower high, and then you have a bear inside bar closing on its low. If I'm a bull and I bought this, I'm going to get out below that bull bar. Aggressive bears will sell that. Other bears will wait for a second or third sell and then take a chance that we go down for a swing and we get back down to the low of the day. This is such a common problem when you're starting out. You got a bear trend, a bull breakout, a higher low major trend reversal, a double bottom pullback, whatever you want to call it, cup and handle, small cup handle, and we're going up. And then we accelerate up. We have a big bull bar and an even bigger bull bar. And we closed above everything to the left, right? But what does the follow-through look like? If the follow-through is also a bull bar and we get 2 closes above resistance, the odds are much higher that we're going up. But if you have 1 close above resistance and then a bear bar, it could be a trap. It could be a higher high double top. And this could be simply a second leg trap. Leg 1, pullback. Leg 2, where leg 2 is a breakout, and it's a very strong breakout, odds are you're going higher. But if you get a bear bar closing on its low, the odds no longer favor the market going higher. So it's really easy to look at that and say, it's got to go up. Look how big that bull bar is. It's a bunch of bull bars. It's a strong breakout. But whenever I see a buy the close type rally where you get 5, 6, 7 bull bars, and then I see a very big bull bar and it's near a top from to the left, I'm not going to buy that close. I want to see 1 more bar. Because if that 1 more bar is a bear bar closing near its low, I know this could be a bull trap. It could be a second leg trap in a trading range day. Leg 1, pullback, leg 2. And if I'm long for any reason, I'm getting out below that bear bar. And bears will sell. They'll take a chance that it's a second leg trap. Leg 1, pull back leg 2, and that leg 2, the breakout, is going to fail, and that we're going to reverse down, and the trading range will continue, right? So a bear bar closing near its low, near a prior high, it could be a trap. So bulls will get out, bears will start to sell below bear bars closing near their lows. It did not become a huge bear trend. It might be a bull flag for tomorrow, but the bulls who did not get out lost money, and the bears who sold made money. So the key is, if you have something that might be a trap and you get a bear bar closing near its low, bulls will get out and bears will start to sell. Now, sometimes you'll get what looks like a bull trap, and instead of trapping bulls, you get an actual bull trend. Very big bear trend, and then a very big bull bar. You can call it a wedge, 1, 2, 3. In any case, you know late in a bear trend day, a strong bear trend, bears are going to take some profits. You know, if you're short and you know your stop is up here or up here, that's a lot to risk, especially late in the day. So you're going to take profits. And here, the bears took profits. Some bulls will buy far below the moving average, looking for a scalp up to the moving average. At this point, all you know is you get short covering going on, and it's a possible bear trap. We're not above a prior lower high, and we have a bear bar closing near its low. So if you're a bull, what do? You're going to get out below that bull bar closing near its low, and if you're a bear, you'll either sell that or you'll wait for a second sell. But instead of triggering the sell, bulls bought the close of that bear bar, and they had limit orders to buy the low of that bear bar. There were so many bulls buying, preventing the sell, we went up a little bit. You could argue this is a sell, but I would not sell below a doji bar. I want to sell below a bear bar closing near its low. This went below that low, but it's 4 bars earlier. I want the sell to take place on the very next bar. I want some sense of urgency. So for me, I'm not going to sell here. I'd wait for a second entry sell. Instead, we have 2 bull bars closing near their highs. This is a breakout. It could be a measuring gap. In fact, we did go for about a measured move up from here to that gap to up to here. Once I see these 2 consecutive bull bars, I'm thinking, this is not a bear trap. This is not a bear trap. This is probably a breakout, and we're probably going up for a measured move. So I think this is a failed bear trap. The bear trap never triggered. We have consecutive bull bars, a breakout, a gap. We're probably going higher. So at this point, instead of buying above bull bars closing near their highs, expecting the market is now in a bull trend. Again, every bull trend, trend reversal, if you have a bear trend that becomes a bull trend, it always begins with short covering, profit taking by the bears. And if it's relentless and they keep taking profits, and if bulls start to pile on and they can prevent a sell signal from triggering, the bulls are in control. Bear traps, the opposite of everything that I just said. Here we have a bull trend and a strong sell-off. Here we have a trading range and a strong sell-off. And here we have a bear trend and a strong sell-off. Anytime you're in a bull trend and you're a bull, you're going to be looking for reasons to take profits. And that's called long liquidation. It's the opposite of short covering. When bears take profits, it's short covering. When bulls take profits, it's long liquidation. And you have to expect it. There's going to be some profit taking in every bull trend, and it creates a sell-off. And sometimes the sell-off is strong enough to make you think you're going to get a second leg down. If instead the bull trend resumes and you don't get the second leg down, any bears who short are trapped. So you can get a bear trap in a bull trend, and if you see a bull bar closing on or near its high, you buy above the bull bar, and the bears who did short, they'll get out above that bull bar as well. The same thing can take place in a trading range. Here we have 5 consecutive bear bars and a very big bear bar. But whenever you see a big bear bar and you look to the left and it's possibly testing a prior low, it might be a sell vacuum test of support. You need follow through, and if you get a bull bar closing near its high, that's exactly the opposite of what the bears want. Any bear who's sold anywhere down here hoping for a break below the low and a measured move down is going to get out below that bull bar. and bulls will start to buy either above that bar or they'll wait for a second entry buy over here. So this is a bear trap in our trading range. And then finally, if you have a strong bear breakout late in a bear trend, it can also be a trap. It could be an exhaustive end of the bear trend, but I don't have time to talk about that today, so I'm only going to be talking about traps and bull trends and in trading ranges. Strong bull trend, small pullback bull trend, small pullbacks and relentlessly higher. You have to expect some profit taking. We have a wedge, 1, 2, 3, a bear bar closing near its low. We've been above the average price for a long time. A lot of the bulls will take profits, and then they'll wait to see how far down we go before they buy again. We sold off, we have a tail, and then we have a bull bar closing near its high. This could be simply a long liquidation, profit-taking sell-off, a bull flag, a test average. I always look to the left. If there's some possibility of a double bottom, either with that low or with this low, it could be a double bottom bull flag. So a reasonable place to take profits. You get some long liquidation, but if you see a bull bar closing near its high, the bears will get out, the bulls will buy, and the bulls had many other opportunities to buy above any of these bull bars closing near their highs. Weak bears see the wedge and sell, hoping for a bear trend, and they see the lack of follow-through of that tail, they see the bull bar, they get trapped into a losing short, and they buy back their shorts. And the bulls, they look for bull bars closing near their highs, and they'll buy for a resumption of the bull trend. So lots of opportunities to buy. You don't take every one of them, but you try to take at least one for a resumption of the bull trend. We're in a bull trend, lots of pullbacks, and then here we have consecutive bear bars, very good-sized bear bars, both closing below the moving average. But look to the left, maybe a double bottom with that, maybe a double bottom with this, maybe a double bottom with this. It came down here, reversed up, down here, reversed up, down here, reversed up, all right? So here we're getting an even stronger sell-off, but do we get follow-through? Do we get closes below all the higher lows? Or do we get a bull bar closing near its high? If you get a bull bar closing near its high, this is probably a bear trap, and bulls will buy above that bar to get long again. We have another version of it here. Possible higher high, major trend reversal. We broke above that high. We reversed down, decent bear bar. Reasonable for bulls to get out, reasonable for bears to sell. But big tail on the bottom, and then a bull bar, and then an even bigger bull bar. This is probably another bear trap. So bear trap, bulls buy above that. Bear trap, bulls buy above any of these bull bars closing near their highs. This tail is a problem for the bears. They need bars closing near their lows, and they did not get it. Here they had two bear bars, but tail and not below all the prior lows. Both turned out to be traps, and bulls will buy above a bull bar closing near its high. A bull scalper is going to buy, take profits, buy, take profits, buy, take profits, all the way up. Swing traders, they'll take any one of these buys and just hold. Bull trend, and going sideways, getting some bear bars, closing on its low, closing near its low, closing on its low, and then a bear breakout. Tail on the bottom, so not as strong for the bears. And whenever I see a bear breakout, I'm always looking to the left. I'm looking for a possible double bottom or a test of support. And big bear bar closing below the low of the past 20 bars, good for the bears. But then we have a bull bar, and if I look to the left, I'm wondering, is this just a test of that support level? When the market went above this level, the bulls bought relentlessly. We're back down to that area where the bulls bought earlier. Will they buy again? So if you're a bear who sold and you see this bull inside bar closing near its high, you got to exit. And if you're a bull, you're very happy because you're assuming the sell-off was just a breakout test, a test of the breakout point, and that the bull trend is going to resume, that it's a failed bear breakout. Whenever you see a breakout test, it never looks like it could go all the way up for a measured move. It never looks like it's going to get there. But whenever you see a breakout test and the bull trend is starting to resume, look at the beginning of the move and then look at the gap. You got to be thinking the market may go up for a measured move. So if you're buying, it's reasonable to be holding for a swing trade. You can see as it got near the measured move target, the market started to accelerate. Why? Because the bears knew it was going to reach the target, so there were no bears willing to sell here. The bulls knew it was going to reach the target, especially high-frequency trading firm type momentum traders. They knew it was going to go up there, so they just started to buy aggressively. We have a bull trend reversal and a wedge, 1, 2, 3, or an expanding triangle, 1, 2, 3, a very strong reversal down. At this point, the market is short. The odds are it's going lower, all right? However, you also know it's retracing about half of the rally, so it's possibly a 50% pullback. It's testing this breakout point. We have a sell climax and we broke above it. So it's always possible to be a bear trap. You need to know what the next bar or two look like. And in this case, we have a big bull bar closing on its high. And if you're shorted anywhere in here and you see this bull bar, you have to get out. You look to the left and say, oh, it might be a breakout test, might be a 50% pullback, it might be an end of the day bear trap. So bears will get out above that bull bar closing near its high, and bulls will start to buy, either taking the first entry or any of the other entries. Anytime there's a bull bar closing near its high, the bulls are going to be buying, expecting a resumption of the bull trend. This is a point that I sometimes make. We have a very strong breakout, a pullback, and then we're channeling up. From this point on, it was a small pullback bull trend. The bars are small, they don't look all that strong. Here we have a 2-bar pullback, not all that big, 2-bar pullback, not all that big, a small pullback bull trend. Whenever you have a small pullback bull trend, you have to assume there's going to be profit taking late in the day. And not only that, you assume that the profit taking will be at least 50 to 100% bigger than the biggest pullback earlier in the day. So when I see the market channeling up in a tight channel, I'm always paying attention to what the biggest pullback was in the channel. We have a pullback here, we have a pullback here. This is still the biggest pullback. And I'm expecting that there's going to be a pullback later in the day that will be at least 50% bigger than this, maybe 100% bigger than this. This blue rectangle is the size of this, and we have 2 blue rectangles, so at this point it's 100% bigger than that. So goal accomplished. It's possible, in fact it's likely at the close of this bar that we're going to get a second leg down. And it turns out this is probably the second leg down. We went down, we went up, we went down, we went up, we went down. This is probably a wedge on a smaller time frame chart. And we have a bull bar closing near its high. It's not a particularly great bull bar, but if I'm short, hoping for a bear trend, and I see a micro wedge and a bull bar closing near its high and about a 50% pullback, and I see this pullback is about twice the size of this earlier pullback, I have to get on my shorts above that bull bar, because this could be an end of the day bear trap. Profit taking that is about twice as big as the biggest earlier sell-off. Bear traps, they can occur in trading ranges. Trading range, we broke to a new high of the day here. We have a micro double top. We went up, we went down, we went up, we went down. Some traders will sell below that bar because it's the neckline of this micro double top, and we're at the top of a trading range. Tried to break above the trading range, failed. Tried to break above the trading range, again, failing. So some bears sold as this bar was forming. Other bears will wait. Here we have an inside bar, bear bar closing below its midpoint. If you're long, you have to get out. You have to know that this is just a bull leg and a trading range and not the start of a bull trend. So the bulls have to get out. And with a surprise bar down like this, we're probably going a little bit lower, maybe testing this low. So the bears will sell. And you got a very strong rally. You get 5 consecutive bear bars, and you have an even bigger bar here, closing below the prior lows, but not closing below, we gapped up here, not closing below the low of the day. And therefore, this could be an end of the day bear trap in a trading range day. And the key, you look for a bull bar. Here we have a very big bull bar closing near its high, and it's an expanding triangle at this point. We have a low, lower low, lower low. We have a high, we have a higher high, and it's a higher low double bottom with this low. We did not fall below this low, and we're reversing up. It's a failed breakout below this trading range. Bears have to get out above this bar, and bulls will either buy above this bar or above this bar or above this bar, expecting that this is trapping bears, and the bears will have to get out, and we could get a reversal back up to the top of the range. So bears get out above the first bull bar. Bears either buy above the first or above any other bull bar, expecting a test back up. We have, excuse me, a sell-off. We have a rally. We're selling off again. Pretty good bear bar. We have, looks like a wedge bull flag. We went down and up, down and up, down with a decent bull bar. And we twice tried to go up, but we failed. So we have a wedge bull flag, which is the first leg down, and now we have a very strong breakout below. We're probably going down for at least a couple legs. So this is a credible start of a bear trend. But you need follow through. And if you don't get follow through, it could be a second leg bear trap. So the first leg down was a wedge bull flag, and now we're getting a bear breakout below the wedge bull flag, but we're not breaking below all the bars to the left, and therefore it could simply be a sell climax test of the bottom of the day. And if you get a bull bar closing on its high right here, bulls will buy. If you have any bull bar, especially with an inside bar like this, bears will buy back their shorts either above the two small bars. They definitely have to buy back their shorts above this, and bulls will start to buy either above the first bull bar closing near its high or above the second one, expecting that this is a second leg trap. First leg down, a bull flag. We have a break below the bull flag, and it looks like we should get additional selling, and instead we're reversing up. I'm sorry, what? 5 minute charts. But the same thing applies on any time frame. The reason why I don't have the price scale or the time scale on the bottom is because you'll see this on any time frame. Weekly chart, daily chart, 60-minute chart, 1 minute chart, 15-second chart, 5-second chart. It doesn't matter what time frame. Now I've been talking about bear traps, but sometimes you get bear breakouts that actually lead to bear trends. We've got a small pullback bull trend. The pullbacks are small and brief. You expect some profit taking late in the day. We have a wedge top, so bears will sell either below that or that, looking for a couple legs down. We have 1, pullback 2, pullback 3, so possibly a wedge bull flag. But it's a tight bear channel, and we do not have a bull bar closing on its high. So that, we might go more sideways here. 2 big bear bars. We probably got at least a small second leg down and profit taking in a bull trend. But the bulls, I said earlier, they like to buy above bull bars closing near their highs. This bar does not close near its high, and it's also in a tight bear channel. Most bulls, I would not buy above that bar. I would wait for bull bars closing near their highs, or maybe we'll go sideways and we'll get a double bottom. So for me, I would not buy here, but some bulls would, taking a chance that it's a double bottom with this low and that we're going higher. But why are we not getting decent-sized bull bars closing near their highs? And plus, why are we getting 4 or 5 bear bars that are bigger than the bull bars? The momentum down is better than the momentum up. So this is suspicious for the bulls. And yes, it's reasonable to get out of shorts above a bull bar if you're possibly having a bear trap, profit taking in a bull trend day. Reasonable to get out of shorts, but that is not a good enough reason to buy. And then you get this. 1 bear bar closing near its low. I'm sorry, I'm going to go back. You have 1 bear bar closing near its low, plus it's the biggest bear bar of all of this. That's warning us that we might go lower. And once you get consecutive big bear bars closing near their lows, this is a sign that the bulls have given up. The bulls have decided it's not a bull trend, it's a bear trend. And by the second bar, everybody's going to be selling below bear bars closing near their lows. Some bears will sell here, but everybody's selling here. Bulls and bears are selling here. The bulls gave up here. So here we had what could have been a bear trap, here, and then here and here, yet we never got a bull bar closing near its high. We never got a bull bar with a body as big as the bear bars. So there was never a good buy, and then we got a very strong breakout. Consecutive big bear bars closing near their lows, probably the bulls giving up and the bears beginning a bear trend. I began by talking about what a trap is. A trap is simply a breakout that looks like it's the start of a trend, but instead it reverses, so it's a failed breakout. And then I'm talking today about traps at the end of the day. And the end of the day bull trap is a strong rally in a trading range or in a bear trend, and it's short covering. And if it does not have good follow-through, bears will sell below a bear bar closing near its low, looking for a resumption of the bear trend. But sometimes you'll get what appears to be a bull trap, and instead of the bear trend resuming, it becomes the start of a bull trend. So if you get a short covering rally at the end of the day, but there's no good sell signal, and then you start to get a bull breakout, it's probably the start of a bull trend and not a failed, and not a bull trap. Bear traps, same thing. If you have a bull trend or a trading range, and you have a late sell-off, but there's no follow-through, and you get a bull bar, especially a bull bar closing near its high, that sell-off is probably long liquidation, profit-taking, and the bulls will be very eager to buy again once they see a bull bar closing near its high. Sometimes you'll get what begins as a likely bear trap, but the market just keeps going down. Sometimes a bear trap can fail. Instead of becoming a bear trap, it can become the start of a bear trend. So if you get a sell signal bar, for example, but the market never triggers the sell, and then you get a bull breakout, it's probably now a bull trend. I'm Al Brooks. Thank you for watching. Does anybody have any questions? 75% of the trading, maybe more, is program trading. Most of the trading in every market, especially a big market like the E-minis or the stock market, most of it is program trading. But it has to be based upon rational human behavior. So it doesn't, to me as a trader, I don't care if it's program trading, it's all going to be rational. Yeah.
It was maybe around slide 22 or so where you were talking about small pullback bull trends,
Mm-hmm.
and then at the end of the day, it had
Profit taking.
And you were talking about a measured move to kind of figure out how far to go.
Right.
How do you determine which pullback?
I look at the biggest pullback. I look at the biggest pullback. Once I see the small pullback bull trend begins, I look at the biggest pullback, and that's the one that I'm looking for, a bigger version of it later in the day.
Once you determine that it is a small pullback bull trend.
Right. I just pay attention to which pullback is the biggest. If I get a bigger one later and it keeps going up, I pay attention to the new biggest one. I'm always looking for that biggest pullback. So, yeah.
I trade the ES. I'm happy with it. How difficult is it to transition price action
To bonds, futures? It's easy. I do it all the time. I trade bond futures. So, yeah.
So you talk about traps, and then you talk about how they fail. So which is kind of a very delicate moment. You have to decide if it's a trap or if you are.
Right.
It's not a trap, right? So the only difference is that, like you showed the last slide, is that you don't have a good bull bar to.
Right. So yeah. If there's something wrong with the bull case, you know, the market probably has to go higher to find bull. If you're looking to buy, right, and you're not getting a good buy setup, the market probably has to go lower to find buyers. Yeah.
How do you define end of day? How close to it?
Traps can occur on the open. They can occur any time during the day. But I'm talking today about profit-taking type traps, usually in the final third of the day. Yeah. Well, the traps can occur at any point in the day. But today I'm talking about profit-taking traps. So it'd be late in the day, final third of the day, final hour, final 2 hours. You know, traders are looking to take some profits. They don't want to risk all the way to a stop that's far away. Yeah.
You trade the 5-minute close stop, right?
Yeah, only, exclusively.
Stepping down the 3-minute at a better entry level?
You know, I have friends who trade the 3-minute for trends, trade the 15-second chart, right? I don't think it matters. You know, there's a trade-off. The smaller the time frame, the smaller the risk. The smaller the price risk, but there's another kind of risk I'll talk about in a second. The smaller the price risk, but also the lower the probability. Whenever you reduce your risk, you're reducing your probability.
So if you
I wouldn't do it. I would pick one chart. You know, either just only look at the 3-minute chart, or only look at the 5-minute chart, or the 15-minute chart, or the 1-minute chart. Just pick one chart, because if you're going back and forth like that, you're going to get all kinds of inconsistencies. You know, you'll think, you know, it'll look like it's a sell in the 5-minute, and then you look at the 3-minute, and it looks like it's a buy.
You use the put-call ratio?
I don't use that at all. Years ago, I paid a lot of attention to it, but I don't use it at all.
You don't see any benefit to that?
On a 5-minute chart, typically I see at least, there are 81 bars to the day, right? I see at least 50 trades a day on the 5-minute chart. How many trades a day am I going to get from the put-call ratio?
I do like 4 or 5.
Okay, so I'd rather stick with my 50. So I see so many things in the 5-minute chart that I don't want to be looking at other things. So. Yeah. Well, thank you all very much. Yeah.
How long do you take in the morning, from the beginning of the market, to when you decide you've got enough information?
Sometimes on the first bar, right? Most of the time, 80% of days have a reversal in the first hour, right? 80% of the days you get some kind of a double bottom, some kind of a double top, a wedge bottom, or a wedge top. So usually 80% of the days there's not going to be a swing on the open, or if there is, you're going to get a pullback in it. So you can trade the first bar, but the probability is low. In general, 20% chance the first bar will be either the high or low of the day. So, you know, you can trade the first bar. If the context is really good, let's say you have a big gap up and a huge bear bar, right? I'm going to sell below that bear bar. But most of the time, if you have a huge gap up and a bear bar, there'll be a big tail below that bear bar telling you the traders bought into the close of that bar and that it's dangerous to sell below it. So it depends on context. In general, I do not trade on the first or second bar. I sometimes do in special situations. Most of the time, I'll wait for at least 2 consecutive bars in one direction before trading. So consecutive bull bars, consecutive bear bars. Yeah. Yeah. Do I pay? No, I just, you know, because they can occur at any time. There are certain times, like 18 bars into the day, 90 minutes into the day, that's a common reversal breakout time. 2 hours, 3 hours, 4 hours, they're common times, right? But you know, I don't pay much attention to that. I'm more interested in what the bars are doing. Yeah.
Your entries, if you do stop entry, let's say above the bar, bull bar, or stop entry below the bear bar, you really put stop order, or you just watching, you know, if it's kind of violates and then just pull back?
Normally I try to enter with stops, but sometimes the market is moving very fast and you can't get in with the stop. And I end up, you know, just entering at the market. You know, because if the market's moving fast, that means everybody wants, okay, time's up. If the market's going up quickly, everyone wants to get into that trade, right? So, you know, so do I. So I'm willing to.